So we had a massive value up here, and the dirty sods went and ran the stops of everybody that wasn't willing to play the narrative, wasn't willing to work the narrative up here. So they ran the stops up here and gave us a great opportunity to sell even more, and gave us even more of an opportunity to sell even more. And we got a great sell-off from that, but still the FOMO the next day on Monday was also sell side. And we got a great opportunity to sell it again at the London Open. You see how this always seems to happen? Look, take a look at this phase here, and this comes back to that commercial structure. So when it comes back to the commercial structure, do you see what happens between 3 o'clock and 8 o'clock here? You see that? It grinds higher, doesn't it? It actually just grinds higher into that 8 o'clock trade area, and then it sells off. And take a look at what happened on Monday from 3 o'clock. Do you see how it grinds higher into, again, 8 o'clock, top of the hour? It grinds higher into 8 o'clock, and then it sells off. And then this morning, okay, it came up to a level. I mean, we knew about this level, and we knew about this level because of the sell we had before. This was the key level that we were using, the FOMO level. But then this morning, it did exactly the same, having dropped from 22.5 all the way down to 15 evens. And then what happens is we're now coming back to this level again here, and it gave us another easy sell at 19 evens. Still sell side value. I haven't been able to buy bonds yet. I thought I was going to be able to buy bonds, but I haven't been able to buy bonds yet. The value is still on the sell side as far as I'm concerned. And we've been able to sell some more 19s, and it's dropped down again to 17s. I mean, that little tiny drop there's $2,000 a contract. That's how big this move is. And I still can't buy bonds. I still can't get long the treasuries. So for 3 days on that FOMO trade, the trade that we've been talking about now for a month. Now, why did I bring out the FOMO trade? Why did I talk about the FOMO trade? Because the FOMO trade is a what? The FOMO trade is an RGL. When do we generally talk about RGLs? Well, the RGL is what we call an inside-out trade, as opposed to an outside-in trade. Does everybody know the difference? Does everybody recognize the difference? The markets have two forms that they can trade in, two very basic forms that they can trade in. You can trade from the inside out, or you can trade from the outside in. Very simple forms here. So we've got a middle price, and we've got a top line. We've got a bottom line. So when normal trading is taking place, you're normally looking at trading from the outside in. In other words, you're trying to find a value sell, you're trying to find a value buy, and you've got a fair value middle. If we then move into a high volatility environment, let's assume it's a high volatility sell. Well, of course, you're going to sell here. That's a no-brainer. But you're also going to potentially sell here, and you're potentially also going to sell here. Because we're now trading from the inside of the market, and we're expecting the market now to go outside. And these types of trades are best served from the process of RGLs. Trading from a key decision point that the dealers are making at a certain price. And that means that in this type of environment, if I sell in this area here, I'm usually going to lose money, right? But if I sell in this area here, I'm now in a good, strong position, because now I'm trading from the inside out. I'm able to take advantage of momentum. I'm able to take whatever I'm able to take, right? I just know what the sell is. I know where the sell is. I can either do it as a fade on springs. I can do as top lines. I can also do it as tipping points. I can also do as BSG squeezes. If you do a BSG squeeze into this bottom edge here, you're going to lose money every time, aren't you? You're going to get turned around and rotated. You're going to do a BSG squeeze into the top edge. You're going to usually lose money. You're going to get turned around more often than not. So it's a very, very important point that when you talk about high volatilities, where swings are kicking off, which is what we're in just now. I don't think anybody can think to themselves, yeah, we're in a low volatility environment. Nobody thinks that ever. Well, it's all right to press these ideas, guys. It's all right to be short at the bottom edges. It's all right to be working into those edges as a seller. And that's what's happened on the treasuries. You can see that every bottom edge. So we sold a lot lower here. We sold lower here. We're still selling lower here. And if you did sell even towards the bottom edges, on every one of these tipping prices, they have made fortunes. Every single tipping price has made a fortune on bonds. And that's the joy of RGLs. And a lot of the times, the problem you've got is by the time you recognize RGL concepts, by the time you kind of get that part of the principle, the RGLs, we start trading from the outside in, and you start losing the value of your RGL. It stops being the big determining factor, and normality comes back in. And that's why when you start hearing a lot of people talking about stuff, the difference is we talked about this over a month ago, and we've been using it ever since. When most people talk about it, when you hear the talking heads talking about it, it's usually time to not do it anymore because, well, if they're talking about it, these guys are usually so late to the party that it's already happened. Well, I don't want to know something that's already happened. I want to know something that's about to happen. And that's the biggest advantage that spectrometer can bring, is it tells you what is likely to happen on what side. So if we get a lower low in price and a lower low in the spectrometer, what are you going to do? You're going to be a seller on pullbacks. If I get a higher high on price and a higher high on the spectrometer, what are you going to do? I'm going to be a buyer on pullbacks. I'm going to be buying top edges. I'm going to be buying for that directional volatility inside out trade. It's really easy. And it's been proven to be really easy today when we talked about that oil trade, wasn't it? A very, very, very high class example of using max spectrometer to get the very, very best outcomes. We have had an oil trap, by the way, which I have lent on. But this is how the trade had eventually developed on oil here. And you can see the spectrometer in all its glory here. You can see the red max here against the red pin zone here is rising. You see the spectrometer is a lot lower than it was before here. We're going to be buying this. This is bullish. And we know that we can buy all the way towards that top edge and still make money. Literally anywhere in there is still a possible buy trade. Anywhere during that rally phase is still a possible buy trade in that phase there. Anywhere. And it does turn out to be true because the price carries on through. But then all of a sudden this red comes in here, which is still a buy trade, but it does fail. And you can see that the volume goes higher than it was there at a lower price at 58. We also started to see some value divergence coming in from real yields. And there was a nice exit. I wasn't a seller. And then all of a sudden, the red is now printing at lower prices. And when the red pin zone, as we touched on Classroom in detail, didn't really touch on it, we really did do a full job on it. When the red is now printing at lower prices, your story should simply be to sell pullbacks. So where's the sell on a pullback? A lot of people might ask the question. Well, look for demand areas. Look for buy side liquidity areas. Well, 57.50 would be reasonable here. Look for the max to go higher than it was before against the volume or the price, and then start working the offer. So long as the price is lower. So long as the price is lower. And then you see the opportunity to play into this. And you see what happened to that sell trade at 57 halves. It's just traded 55.25s. A simple max entry has just returned. Well, think about it. I mean, it's not a long trade. Single max entries just returned whatever price you took. Over $2,000 on that second opportunity to sell the trend. The first sale wasn't good enough. The second one I took, because we'd already lined this up, interestingly enough, in a Classroom conversation we had. Actually, I touched on this in Classroom. And the takeaway from that has been spectacular. Now, as I said, we do have a trap on the oil at the bottom edge, which is a measure, interestingly enough. We also talked about that as well, didn't we? So when you look at these trap areas, and you start looking at drawing in these areas, see if we draw line to line. Do you see what happens when we draw line to line? Look at where you expect to see these areas. Do you see how that helps you with your market structure analysis as well in these areas here? And you see that they trapped off the oil price at exactly that point as well. They trapped off that level 2 liquidity because you see the prior buyer coming in. And as the prior buyer comes in here, it sets up this run to the stops and take the trap out. And then we've gone bid off the trap, haven't we? Then we've gone bid off the trap. And that's turned out to be quite a nice buy-side bounce off that trade. Quite a strong bounce. I don't particularly like it. Swap dealers are still sell-side. Real yields are still telling us to be sell-side commodities. So I didn't like the buy myself, but it was a great place to book your monies, wasn't it? A great place to start saying, you know what, let's take some of that cash and walk away. Anyway, what's the chatter this morning? Well, the Chinese are to blame for what you've seen. Yes, the Chinese are to blame for what you've seen. They've added 84% additional tariffs onto American goods. So they're to blame for that one. Nobody else puts 84% on. And like we said, I mean, it's you know, you can blame Trump all you like, but nobody has to retaliate if they don't want to retaliate. They make their own decisions. They're big boys and girls, so they can make their own decisions. So, yep. So what we saw was the market reacting to China adding tariffs onto American goods. Forget about everything else prior to that. That's what the market's reacting to. Stop putting a political bent on it. There should be no political bias in your trading. You trade what you see, you trade what happens, and you forget about the bloody politics. Trade what's happening. The market went down because China put tariffs on products. That's the end of the story. And that's exactly what happened. So we start watching that story evolving and we look for the next opportunity. So same things happening in terms of the smart money. We've seen some crazy good commercial trade opportunities against some of the smart money levels. We do have some interesting outcomes this afternoon as well, guys. There's not a lot of data-wise today. It's a very quiet day. The Kiwis in the overnight session did cut their rates by 25 basis points to 3.5. Japanese consumer confidence was slightly down from the forecast of 34.7 to 34.1. There's no European data today of any real interest, and there's no US data as such, or European or British data of any real interest. We do have the crude oil inventories at its usual time slot today at 3:30. We also have the 10-year bond auction at 6 o'clock. Now, this is going to be very interesting to see whether there's a real demand for these bonds at these prices, because we've got I think we could probably argue we've got a bit of a concession. What do you think? Anybody think we've got a bit of a concession? Well, if you think we've got a bit of a concession, we should see massive buying. But what if people still don't think it's big enough? Well, we're going to see a problem there, aren't we? We're going to actually genuinely see a problem, because if that's not big enough a concession, what do they think is going to be big enough before that concession starts coming in? So, that's something we're going to start watching for. We're going to see this should bring a lot of demand into treasuries. Does it? That's the question. It's not a political bloody question. It's just a did it happen or did it not happen? I don't care why. I just trade it, right? I just trade it. So we've got to make sure that we understand these elements to trading. Trading doesn't care for your opinions or anybody else's. They just react to what they see. They react to what they believe. They react to the pricing mechanism of the markets. And that's kind of what's happening at the moment, right? That's kind of where we're at just now with the trading world, is that it's a reaction, counter-reaction, a wind and unwind position. It's a very, very fluid situation. And by the time you've thought about it, it's probably changed, right? So that's the way it works at the moment. In terms of the commercials, they were actually quite constructive this morning, but they suddenly decided at around about 11 o'clock that they didn't like it anymore. And that was about an hour before China came out, interestingly enough. About an hour before China came out, the commercials on our desk started to sell hard, and paid attention to that at that point. They did obviously close out a lot of their positioning again, and then they started to sell back in again as we started to reach around about 12:30. And they haven't been buying since 12:30. The commercial desks that we are trading with have been selling since about 12:30 today. So 12:30 on this chart here is the commercials have been selling this area here, the 17,100 on the NASDAQ. And they've had a reasonable sell side profit on that short, haven't they? They've had a reasonable bit of a downside movement. They're still selling. They're selling at the lows at the moment. And interestingly enough, our red line is actually going higher into even these lower ledges here. So 17 handle looks as if it's the big 17 handle looks as if it's also got a lot of commercial interest on the short. They're not getting much for their selling, though, are they? They're not getting very far for their selling. Even when there's a lot of buyers coming in here, you'd have imagined that this should have popped a quick one down to the 16,900 break, possibly 16,800s. But that hasn't happened yet. So I'm a little bit curious to know who's on the other side of that trade, because it's certainly not us. Sell side only on that bit of business at the moment. We've talked about business in a box again this morning. We talked about the sell on the gilts market. Well, that's worked out rather nicely, hasn't it? The sell on the gilts market, well, it's spectacular, if you must know. Absolutely spectacular. Sell side gilts, and we've crashed the gilts market from 91.40s all the way down to 90 evens. 140 points in the gilts market is quite a big move in normal terms. You can see that from the background chart here. You can see that on a single day basis is pretty good for what we've seen so far. Pretty good outcome. Sell side gilts, sell side equities for me at the moment, and let's see how the day progresses. We're watching this oil for selling opportunities, as you probably can imagine. We showed you that just a short while ago. Did you get one? Well, we started to see the commercials coming in as a buyer here, so perhaps you've a seller. So perhaps you've just sold some 90s here on the M's. If you did, $400 short sell. That'll do, donkey. Why would you have been looking? Well, you can see that the max volume is higher than it was before, suggesting a lot of volume getting trapped in here. And that gives you an idea that with the swap dealer still sell side, as I mentioned, I haven't been a buyer of oil into this swing low. I am keen to be short. So when the swap dealers are selling it and then the volume goes short into this tested high, you're watching for the commercials showing up. When they show up, it's time to get busy. It's time to get short. It's time to get ill. It's time to do what you need to do to get that bit of business done. And it's a reasonable profit, $400. You were only in the market for approximately 3 minutes, and you've already picked up $400 in that little easy money swing from that trade at the moment. Anyhow, and breathe. Welcome in, guys. I hope you're all good, ready to rock and roll. And we've got a lot of stuff to unpack, haven't we, in terms of the Fed? What's the Fed going to tell us about? We'll take a look at the dots plots later on this afternoon. And we'll think about what those Fed minutes might reveal to us. Are they worried? Are they not worried? What are their thoughts about the impact of inflation in terms of tariffs? If tariff-driven inflation, are they worried about that? Are they not worried? What are they talking about? It's a really important set of minutes this time round to see where their heads are on these narratives, right? Really important. Because remember, the Fed has to play the same type of game. They've got to kind of almost remain out of the politics, and that's not a bad thing. They've got to try and remain out of the politics and focus on the outcomes. And that means that for a lot of times the Fed is a lot of times they'll basically say, well, we'll have to wait and see. We'll have to wait and see what happens next, which means that Fed is generally going to be behind the curve. And it's not a bad thing as a trader to recognize this as well, because a lot of people allow emotions, their own personal emotions, to cloud their trading judgment because they don't like the response. They don't like the way the market's behaving to certain things. It doesn't matter. The market couldn't care less what your political swing is, whether you're pro or against. You just trade the bloody reaction, guys, and get on with it, right? Simple as that. Anyway, I'm going to grab some lunch. I don't know what's on the menu, but I'm sure it'll be pretty good. Welcome in, guys.